So if you've ever bought gold, like you're trading XAUSD because you saw this massive, perfect green engulfing candle,
Wow.
only to watch the market instantly crash and, well, take your money. You know, you didn't experience bad luck.
Right, definitely not bad luck. You experienced a perfectly executed institutional trap.
Exactly. I mean, you've been trading based on candles, you've memorized all the little cheat sheets, you see the signals, but your entries still just, they fail.
Yeah, and it is a brutal reality to wake up to. I mean, it's the exact threshold where most beginners either completely blow up their accounts and walk away forever, or, they finally decide to look beneath the surface of the chart.
Yeah, let's just sit with that reality for a second, because we need to paint a picture of what this actually looks and feels like for the trader sitting alone at their desk.
Oh, for sure. It's an emotional roller coaster.
It really is.
Yeah.
So picture this. You have a basic understanding of market structure, and you're sitting at your screen watching the XAUSD chart. Your heart rate is, like, slightly elevated,
Yeah, you're waiting for that perfect setup.
Right. And then you spot a pattern right at what you've identified as a key support level. Let's say it's a textbook bullish engulfing pattern.
The one everyone learns on day one.
Exactly. Your brain immediately fires off like, this is it. The buyers are stepping in. This is the signal. So you click buy. You place your stop loss just below the low of that candle.
Feeling pretty confident.
Yeah, feeling great. And almost instantly, before you can even take a breath, the market violently reverses. It just crashes right through your support line, triggers your stop loss, and takes your money.
And that's where the panic sits in.
Completely. But worse than losing the capital, you lose your confidence. You're left staring at the screen, feeling completely paralyzed, thinking, this is exactly what the textbook told me to do, and I just don't understand why it keeps happening to me.
I've been there. And look, that feeling of paralysis, it comes from a fundamental misalignment in how you perceive the market.
How so? Like, what are they seeing wrong?
Well, you are trying to read a highly complex predatory environment by just looking at the shapes of the candles without understanding the underlying order flow or the liquidity mechanics or the actual intent of the institutions moving the price.
So it's like reading the letters but not knowing the language.
Exactly. You see a shape, but you don't know the story behind it.
And that actually brings us to the mission of today's deep dive. We are taking a massive stack of sources. I'm talking professional institutional trading guides, smart money concepts, deeply researched psychological frameworks.
Any real heavy hitters.
Yeah. And we are going to completely rebuild how you see candlestick trading in Forex. Specifically, we are focusing on gold.
XAUUSD. The beast.
The beast, right. And just to be clear on the tone today, this is entirely analytical. Like, there is no hype here. There are no exaggerated promises of sudden wealth or Lamborghinis.
Please. No, we're keeping it serious.
Right. We are dissecting the mechanics of the market to move you from that state of confusion and hesitation into a state of absolute objective clarity.
Because we really need to replace that fear of the unknown with the calm authority that, only comes from understanding how the engine actually works.
Absolutely. So let's start at the foundational level, but I want to skip the absolute basics. Like, our listeners know what an open, close, high, and low are.
Yeah, we don't need to explain what a rectangle is.
Exactly. We know what a wick is. What we don't understand is the actual order book mechanics behind them. When we look at a candlestick, we shouldn't just be seeing a green or red shape on a screen.
No, absolutely not. You have to view a candlestick as a visual historical record of a violent battle. It's a battle for liquidity between buyers and sellers within a highly specific time frame.
A battle. I like that.
Yeah, and the most critical piece of data in that battle is not the high or the low, it's actually the close.
Why the close specifically?
Because the close represents who ultimately won that specific battle and secured final control. Now, obviously, the space between the open and the close forms the body of the candle. But let's talk about what a strong, thick body actually means, like mechanically. In institutional terms, a massive candle body represents something called displacement.
Displacement. Okay, I hear that word thrown around a lot. Break down the mechanics of that. Like, what is physically happening in the order book to cause displacement?
Sure. So displacement means there was a severe, undeniable imbalance of power.
Okay.
It means an institution, or maybe a collective of smart money, entered the market with an order so large that the opposing side just could not absorb it.
They just overwhelmed them.
Exactly. Imagine the order book. If you have a massive market buy order come in, it instantly consumes all the sell limit orders at the current price.
Right, it eats them all up.
And then it consumes the sell orders a pip higher, then 2 pips higher, sweeping through the order book until that massive buy order is entirely filled.
Wow.
Yeah, and that violent sweeping of the order book leaves a massive green body on the chart. One side effortlessly moved the market because the other side, well, they had zero liquidity to offer.
I see. And on the flip side, a very small body, like a doji or a spinning top, that represents a balanced order book, right? Like a stalemate where buy and sell orders are just matching each other tick for tick.
Exactly. It's a tug of war where neither side is really moving the rope. But the relationship between that body and the wick is where the real story is told, especially on an asset like gold.
Oh, for sure. Let's pivot to XAUUSD specifically, because gold does not behave like the euro or the pound. It's a totally different animal.
It really is. It's incredibly volatile.
Yeah, like it regularly moves 200 to 500 pips in a single day. So when you look at a gold chart, you see these massive long wicks everywhere. To a beginner, it just looks chaotic.
Well, to the untrained eye, yeah, it is chaotic. But in the context of gold, those long wicks are rarely just random market noise or, natural price exploration.
So what are they?
They represent intentional surgical liquidity manipulation by major institutions.
Wait, really? Intentional manipulation?
Absolutely. Because gold is so heavily traded, institutions use these fast, volatile spikes to trigger emotional reactions.
Right. The FOMO or the panic.
Exactly. They drive the price rapidly into an area to clear out stop losses, absorb all that liquidity, and then immediately reverse the price. And that leaves a massive wick behind. The wick is quite literally the footprint of a trap.
Man, that is eye-opening. And this highlights the ultimate beginner's misunderstanding, I think. The beginner looks at the chart and thinks the color of the candle guarantees certainty.
Yes, the classic green means go mistake.
Right. Let me push back on this, actually, because it's the exact scenario I brought up at the start. If a massive green candle closes, showing total buyer dominance, a thick body, incredible displacement, why do retail traders still get crushed buying immediately after it? Doesn't that big green candle mathematically prove the buyers are in absolute control?
It proves they were in control for the duration of that specific candle. But you really have to distinguish between initiation and exhaustion in the order flow.
Initiation and exhaustion. Okay, explain that.
So if a market has been pushing up and suddenly you see the largest green candle of the entire day, a retail trader sees that as a signal to jump in. They think, momentum is peaking.
Yeah, they think the breakout is happening.
Right. But an institutional algorithm sees that massive expansion as an exhaustion event.
Wait, why exhaustion? If it's the biggest candle, doesn't that mean the most money just poured in?
Yes, but whose money? The buyers have spent massive amounts of capital pushing the price to that extreme. They have consumed all the available sell-side liquidity in the immediate area.
So there's nobody left to buy.
Exactly. There is no one left to buy at that elevated price. So the smart money, who bought earlier in the move, uses that massive green candle, which is now full of eager retail buyers experiencing FOMO, to quietly offload their positions.
Oh, wow. So they're selling into the retail buying frenzy.
Yes. They sell their massive holdings directly to the retail traders who are desperately trying to buy the breakout. The green candle wasn't the start of a new move. It was the final trap at the end of the old one.
That is a fundamental paradigm shift. So if you're listening right now and you've ever stared at candles and still felt completely lost when a big green candle suddenly turns against you, comment why I know I'm speaking to the right people. Because that concept of exhaustion is critical. A candle is the exhaust fumes of a battle, not a green light to enter.
That's a perfect way to phrase it. And this means we can't just look at one candle in isolation. It's mathematically dangerous.
You absolutely cannot. And that forces us to move from the anatomy of a single candle to how multiple candles interact sequentially. Because like you said, trading isn't about reading one battle, it's about reading the entire war.
Exactly. You have to look at the broader behavioral sequence.
So let's talk about sequential behavior.
Yeah.
The core concept here that shatters the beginner mindset is that candles are not signals. They are reactions. They are reacting to liquidity and previous price action.
Right. If you are looking at a chart, you must apply sequence logic. A single candle just tells you what happened in the last, say, 15 minutes. But a sequence tells you the actual narrative.
Okay, what does a healthy sequence look like?
If you see a sequence of strong, full-bodied candles in one direction, that sequential behavior means continuation. The trend is healthy, orders are flowing smoothly.
And a weak sequence.
If you see a sequence where the bodies are shrinking and the wicks are growing longer and longer on both sides, that sequence means hesitation. The momentum is dying and the order book is thinning out. You're probably looking at a shift or a possible reversal.
Our sources actually emphasize two distinct phases in the sequential behavior that are critical for gold traders to understand: compression and expansion. I really want to spend some time on compression because I feel like it's usually the part of the chart where traders just get bored and look away.
And that is their biggest mistake, by far. Compression is when the market moves sideways in a very tight overlapping range.
Like consolidation.
Yes. You will see a sequence of small candles, wicks crossing over each other, just moving nowhere. To a beginner, it looks completely untradeable. It's just chop.
Right, nothing's happening.
But what is mechanically happening beneath the surface is the coiling of energy.
I always think of it like tectonic plates, you know? If you look at a fault line from above, the ground looks perfectly still, nothing is happening at all. But underneath, the pressure of two massive plates grinding against each other is building to an extreme degree.
That's a really good analogy.
And the longer they sit there, locked in compression, the more violent the eventual earthquake is going to be.
That is exactly how the order book works. During compression, orders are building up massively. Day traders are taking small positions inside the range. Breakout traders are placing buy-stop orders just above the resistance line.
And sell-stop orders just below the support line.
Right. And retail traders who are already in positions, well, they're trailing their stop losses tightly behind the compression zone. So the market is essentially building massive pools of liquidity on both sides of this really tight channel.
Just waiting to be triggered. And the violent release of that pressure, that's the expansion.
Yes. You will see massive displacing candles breaking out of that compression zone. But, and this is crucial, in gold, this transition from compression to expansion almost always features a very specific, highly predatory behavior.
The fake move.
The fake move.
Okay, so if you want us to break down exactly how to read candles step by step through this behavior, comment candle below. But let's get into it right now. Explain the exact sequence of the fake move. How does it trap both sides?
All right, let's say gold has been compressing for 4 hours. The algorithmic logic of the market knows there are massive pools of liquidity sitting above and below this tiny range.
Right.
First, the price will violently spike upward, breaking out of the compression zone.
Which instantly triggers all the buy-stop orders of the breakout traders.
Exactly. They get pulled into the market thinking the bullish expansion has officially begun. Simultaneously, that upward spike hits the stock losses of anyone who is shorting the market from inside the compression zone.
Oh man, and remember, a short seller's stop loss is a buy order?
Yes. So you have breakout buy orders and stop loss buy orders all triggering at the exact same millisecond.
Generating just a massive surge of buy-side liquidity.
Huge. And what does the institution do with a massive surge of buy-side liquidity? They use it to execute their true intention, which is a massive short position.
Wow, so they sell heavily into that synthetic buying pressure.
Precisely. Once their massive sell orders are filled, the artificial buying pressure just vanishes. The price instantly collapses back into the compression zone and then aggressively breaks out the bottom of the range, delivering the real, sustained move downward.
So the breakout traders who bought the high are instantly trapped in huge drawdown, and then they're stopped out as the price crashes down through the bottom.
Exactly. The beginner trades the initial breakout and gets absolutely slaughtered. The professional sits on their hands, watches the compression, waits for the fake move to sweep the liquidity, identifies the sequence shift, and enters alongside the institutions on the real expansion.
That is it perfectly illustrates why simply knowing what a bullish candle looks like is so dangerous.
It really is.
Which naturally leads us into the concept of candlestick patterns. Because if sequential behavior dictates everything, then the classic patterns everyone memorizes must be deeply misunderstood.
Patterns are arguably the most misunderstood concept in all of technical analysis. Beginners treat them like magical cheat codes.
Yeah, they buy a poster, stick it on their wall next to their monitor.
Right. And they think if they memorize the shape of a hammer or an engulfing candle, the market owes them a profit. But patterns are not magic. They are simply the visual result of human psychology and institutional intent playing out in the order book. That's all they are.
Let's dismantle the big three patterns our sources highlight, starting with the engulfing pattern. Because I hear smart money concept traders talk about this constantly, but usually it just sounds like they are describing a big candle. What is mathematically happening during an engulfing pattern?
So an engulfing pattern is a two-candle sequence. You have a smaller candle, let's say a red bearish candle, followed immediately by a much larger green bullish candle that completely covers or engulfs the entire body and wicks at the first one.
Right, it just swallows it whole.
Exactly. Behaviorally, this represents a total undeniable shift in control. The sellers thought they had dominance during the first candle, but in the second candle, buyers stepped in with such overwhelming force, such massive displacement, that they consumed all the sell orders and pushed the price significantly higher.
Trapping the sellers from the first candle?
Yep, they're totally trapped.
Okay, next is the pin bar. Some people call it a hammer if it's at the bottom or a shooting star at the top.
Right. A pin bar is defined by a very small body and an exceptionally long wick on one side. This pattern represents a total aggressive rejection of a price level.
So a liquidity grab.
Yes. If you see a pin bar with a long wick pushing down, it means sellers tried to drive the price lower, and they succeeded temporarily, but they hit a massive wall of institutional buy limit orders.
Like hitting concrete.
Exactly. The buying volume was so immense that it not only halted the selling, it absorbed it entirely and pushed the price all the way back up to where it started, leaving that long wick.
And finally, the doji, the little cross shit.
The doji occurs when the open and close prices are exactly or nearly exactly the same, leaving a very small body with wicks on both ends.
So it's a tie.
Right, it represents a true equilibrium in the order book. Total indecision. Neither buyers nor sellers could establish dominance. But listen, a doji itself isn't a signal to enter. It is a transition phase.
It's like a warning light.
Yes. It tells you that the prior momentum has hit a wall, and a shift in direction or a period of compression is highly likely.
But I want to stop here because our sources are absolutely screaming one specific rule, and it's the reason why pattern traders lose money constantly. The context rule.
Oh yes. If you take away nothing else from this discussion, understand this. A pattern alone, in a vacuum, is completely meaningless.
Say that again for the people in the back.
A pattern alone is meaningless. I see traders daily asking, is this a valid pin bar? I cannot tell you if it's valid without seeing where it is on the chart. If you see a beautiful textbook bullish pin bar forming in the middle of a random, choppy, sideways market on a 5-minute chart, it is just noise. It has zero predictive value.
Because there's no larger narrative giving it weight.
Exactly. But if you see that exact same pin bar forming right at a major, heavily defended institutional demand level on a 4-hour chart, now you have a high probability setup.
The location dictates the value.
Yes. A hammer is only useful if you use it on a nail. Swinging it at the air accomplishes absolutely nothing.
Okay, here's where my skepticism kicks in. And I know listeners who follow smart money concepts are thinking the exact same thing right now.
Let's hear it.
If everyone, I mean literally every retail trader with a YouTube connection knows what a bullish engulfing pattern looks like, and everyone knows what a pin bar looks like, why do institutional algorithms allow them to form?
That is the million-dollar question.
Right, aren't the big players showing their hand? Like, if an institution is trying to quietly accumulate gold, why would they leave a massive screaming pin bar on the chart for all of retail to see and copy?
That is the perfect question to ask. And the answer is, they aren't just allowing them to form, they are actively engineering them.
Wait, really? Engineering them?
Yes. And they are using the retail traders as the raw material to build them.
Okay, you have to walk me through that. How do you engineer a pattern?
Think about the pure mechanics of liquidity. An institution needs to buy a massive amount of gold, say 10,000 lots. To do that without spiking the price to the moon, they need an equal amount of sell orders, 10,000 lots of selling pressure, to absorb their entry.
Right, someone has to be selling for them to buy.
Exactly. Where do they find that? They look at the chart and see a clear, obvious support level that retail traders have drawn a little line under. They know retail traders have placed thousands of stop losses just below that line.
And again, a retail buy order's stop loss is an automated sell order.
Right, so the institution uses a small portion of their capital to aggressively short the market, driving the price down just below that retail support line.
The line breaks.
The line breaks. Retail traders see the break, panic, and hit sell to try and catch a breakout. Simultaneously, all those hidden stop losses are triggered, flooding the market with automated sell orders.
So they've basically created a cascading avalanche of sell-side liquidity.
Yes. And at that exact moment, the institution steps in with their true order, the 10,000 lot buy. They absorbed all of that panicked retail selling effortlessly.
Oh, wow.
This sudden massive influx of institutional buying power instantly halts the downward move and violently pushes the price back up above the support line.
And what does that look like when the 1-hour candle finally closes?
It leaves a long wick at the bottom where the price dipped below support and a strong body at the top. The institution just manufactured a textbook pin bar.
That is mind-bending.
They didn't give away their game plan. The pattern is simply the exhaust fumes of their liquidity sweep. The retail trader sees the pin bar and thinks, oh, a magic pattern appeared. The institutional trader sees the pin bar and knows the trap was successfully executed and the liquidity was absorbed.
So the pattern isn't predicting the future, it's documenting the manipulation that just occurred.
Exactly.
Listen, if this is starting to change how you see the market, comment real down below, because this is a huge paradigm shift.
Yeah.
But if patterns are just footprints of manipulation, how do we actually navigate the chart? How do we know where these manipulations are likely to happen?
Well, to navigate footprints, you need a map. And in trading, the map is market structure.
Okay, let's get into market structure then, because this is the framework that gives context to everything we just discussed. If I look at any SMC analysis, there are two acronyms that dominate every single conversation: BOS and CHCH. Let's start with BOS, break of structure.
A break of structure is the mechanical confirmation that a trend is healthy and continuing. If you're in a macro uptrend, the market will make a high, pull back to make a low, and then push up again.
Creating higher highs and higher lows.
Right. When the price successfully pushes past that previous significant high, that exact moment is a BOS. It tells you the buyers have enough capital and conviction to breach the old ceiling and establish new, higher prices.
Simple enough. But THCH, change of character, that one seems to confuse a lot of people. It usually just sounds like people drawing arbitrary lines on a pullback and calling it a reversal. What makes a CHH a mathematical shift in the market rather than just a random dip?
A change of character is your early warning system. It is the very first structural clue that the underlying order flow is shifting. Let's say you're in that same strong uptrend, making higher highs and higher lows. The buyers are in absolute control. But suddenly the price drops and completely breaks below the last significant low.
The floor that the buyers were defending.
Exactly. The fact that the buyers failed to defend that previous low means their capital is exhausted or the sellers have completely overwhelmed them. The literal character of the market order flow has changed from bullish dominance to bearish aggression.
So it's not a confirmed downtrend yet, but it's a huge red flag.
It is the critical first signal that a reversal is imminent.
But reading structure isn't just about drawing horizontal lines and seeing if the price crosses them right. Our sources highlight a crucial difference between validating a real break and getting trapped by a fake break. And this ties perfectly back to candlestick anatomy.
This is where beginners get chewed up daily, especially on XAUSD. A real break of structure requires conviction. You cannot just look at the price ticking past your line. You must wait for the candle to close.
The close is everything.
A real break requires a strong candle body to close firmly beyond that previous high or low. The body proves that the market didn't just visit that price, it accepted that new price level and stayed there.
But a fake break.
A fake break, or a fake out, occurs when the price pierces the structural level, but only with a wick. The candle opens, the price surges past your line, triggering all the breakout algorithms, but then it meets massive opposition.
The order flow reverses.
Right. And the body of the candle gets rejected, closing back inside the previous structure.
So the market explored the area, found no acceptance, and retreated.
Exactly. And in gold, fake breakouts are notoriously common. They're almost a built-in feature of the asset. Gold utilizes fake breakouts to systematically cleanse the market of weak hands.
Just shaking out the retail traders.
Breakout traders see the price cross a line by 2 pips, they blindly enter the trade, and gold immediately wicks back, stopping them out before the real move happens.
Which perfectly transitions us into the absolute core of today's deep dive. We keep mentioning these traps, these fake outs, these long wicks, sweeping support. Why do they happen so frequently, specifically in gold?
To answer that, we have to look at the invisible fuel driving the entire financial system. Let's talk about liquidity.
Yes, liquidity. This is the secret sauce.
Liquidity is the single most important concept a trader can master. Everything else, patterns, indicators, trend lines, it's all secondary to liquidity. Liquidity is simply the presence of available orders, buyers willing to buy, and sellers willing to sell at a specific price point.
And we established earlier that major institutions, the smart money, they trade in sizes so astronomically large that they cannot just open their brokerage app and click buy.
Right. If an institution tried to market buy a massive position in a low liquidity environment, they would experience catastrophic slippage. They would move the price so violently against themselves that their average entry price would be terrible, ruining their own trade.
So what's their solution?
Their entire algorithmic objective is to locate, engineer, and consume vast pools of opposing orders, liquidity, to absorb their massive entries.
And where do they find these massive pools? By engineering what SMC traders call a liquidity sweep or a stop hunt. Let's really focus on this concept because understanding the liquidity sweep is how you stop being the prey.
It really is.
So walk me through the exact anatomy of a sweep.
A liquidity sweep is a deliberate, sudden jolt in price, designed to pull retail traders into a false move, flip them over, and force mass liquidations. It is a highly calculated hunting tactic, and it almost always occurs around areas of equal highs or equal lows.
Which are just retail double tops and double bottoms.
Precisely. Retail trading books teach people that a double top is a strong resistance. Sell at the double top and put your stop loss safely above it.
Right.
So imagine a chart with two perfectly even peaks. To an institutional algorithm, that double top isn't a wall of resistance. It is a glowing neon sign that says, a massive pool of buy-stop liquidity resting just above this line.
Because all those short sellers have their protective stop losses sitting there, which, again, are automated by orders.
Right. So the institution wants to enter a massive short position for the macro trend. They intentionally drive the price upward, breaking past those equal highs.
Springing in the trap.
The moment the price crosses that line, pandemonium hits the order book. Breakout traders see the resistance break and hit buy. Short sellers have their stop losses triggered, forcing them to buy.
The algorithm has successfully engineered a synthetic buying frenzy.
And into that frenzy, the institution flawlessly executes their massive block of sell orders they're selling to all the retail traders who are desperately buying.
Unbelievable.
Once the institution's orders are completely filled, the artificial buying support vanishes. The massive weight of their new short position takes over, and the price violently reverses downward.
And the sequence on the chart leaves a very specific fingerprint. Spike, rejection, directional move.
Yep.
The price spikes up through the level, gets violently rejected, leaving a massive wick, that stop hunt, and then moves heavily in the true intended direction.
It is masterful. They engineered the fake breakout to generate the liquidity they needed for the real move. If you do not understand this sequence, you will be the one providing the liquidity. You will be the one buying the top of that wick.
I'm picturing a commercial fisherman right now. Like, a professional fisherman doesn't put on scuba gear and chase individual fish around the ocean with a spear. That's exhausting, inefficient, and impossible to scale.
No, of course not.
He studies the currents. He knows where the fish naturally gather, the reefs, the drop-offs, the sunken ships. He drops his bait right there, waits for the school to swarm, and then he casts a massive net. The retail traders drawing trend lines and putting their stops above equal highs, they are just schooling around the reef.
Yep.
The institution isn't chasing them, it's just casting the net where it knows they naturally gather.
That is a phenomenal analogy. The equal highs and lows are the bait. The stop losses are the fish. The wick is the net.
Listen, if you want a deeper breakdown on gold manipulation specifically, comment XAU right now, because this stuff is game-changing. Okay, so this brings us to the most practical part of the deep dive, the entry process.
The fun part.
Right. Now that our listener understands the anatomy of a candle, the sequential coiling of price, the truth behind patterns, how to read market structure, and how to spot a liquidity sweep trap, how do they actually execute a trade without getting slaughtered?
You start by internalizing the golden rule of candlestick trading. Trading does not equal reacting to one single candle.
Ever.
Never. You never ever see a shape forming and blindly click a button. You need a process, a rigid, mechanical, step-by-step entry model that protects your capital.
Okay, let's outline that correct process.
Yeah.
You want a full entry model using candles, comment entry. Let's give them the goods. Step 1.
Step 1. A pattern appears at a key level. For example, you observe a liquidity sweep below a major structural low on the 1-hour chart, and it creates a clear pin bar. The trap has been sprung, the equal lows were swept, the footprints are there. But, and this is crucial, you do not enter yet.
Keep your hands off the mouse. Step 2.
Step 2. Wait for confirmation. You need the market to prove its intent on a lower time frame. You drop down to the 15-minute or 5-minute chart. You wait for a change of character, a 2HEH.
To show the momentum is actually shifting.
Yes. You want to see the price break above the last lower high, proving that the buyers who created that pin bar are actually taking control of the structure. Furthermore, You want to see the creation of an institutional footprint, like a fair value gap or an order block.
Let's pause and define those mechanically, because we promised to explain the how, not just the what. What exactly is a fair value gap in the order book?
A fair value gap, or FVG, is the physical evidence of displacement. It occurs when a candle moves so violently in one direction that the subsequent candles do not overlap its range.
Leaving a gap.
Right. In the order book, it means the price repriced so quickly that one side of the market offered absolutely zero liquidity. It left a gap in the traded volume. The market hates inefficiency, so price is magnetically drawn back to fill that gap.
And an order block.
An order block is simply the last opposite color candle before that massive displacement. It is the footprint of where the institution injected their capital.
Okay, so we've seen the sweep, we've dropped to a lower time frame, we've seen this CHOCH, and we see an FVG or order block formed. Step 3.
Step 3. Enter after validation. You wait for the price to retrace. You let it pull back down into that newly formed order block or fair value gap, and you execute your entry there. The sequence is always rejection of the sweep, pull back into the inefficiency, continuation of the new trend. You are entering on the secondary test, not the initial emotional spike.
Let me play devil's advocate here, because the psychology of this is incredibly difficult. If I am watching gold and I see a massive liquidity sweep below support and a perfect textbook pin bar closes, my instinct, my adrenaline is screaming at me to jump in right now.
Oh, absolutely. The FOMO is real.
I feel like if I wait for a pullback that might never come, I'm going to miss the rocket ship.
Yeah.
Why is waiting for that pullback so critical?
Because the fear of missing out, that FOMO, is exactly what the algorithmic models use to extract your wealth. Yes, occasionally the market will launch without you, but probability dictates that the market will retest that level.
Why does it have to retest?
Because institutions often have to leave limit orders behind to mitigate their own positions. By forcing yourself to wait for the pullback, you accomplish two critical mathematical objectives.
Which are?
First, you confirm that the reversal is real. Often, an initial spike is just a temporary pause before the market continues dropping. Waiting for the pullback and seeing it hold confirms the shift in order flow. Second, and most importantly, you drastically improve your risk-to-reward ratio.
Explain the math on that.
If you jump in on the initial massive spike, your entry price is very high, but your stop loss still has to logically go below the low of the sweep wick. That means your risk is huge, maybe 50 or 60 pips on gold.
Right, it's a massive stop.
But if you wait for the price to retrace 50% back down into an order block, your entry is much closer to your stop loss level. Your risk is now incredibly tight, maybe 15 pips. By waiting, you've cut your risk by 70%, which exponentially increases your potential reward multiple. Waiting is not about being timid, it is about protecting your capital through superior mathematical positioning.
That is a brilliant breakdown. But look, having the perfect technical model is completely useless if your mind is actively working against you. Which brings us to the final, and perhaps most vital, core topic: the psychology of frustration and losing.
This is the invisible barrier that separates the perpetual amateurs from the professionals.
Without a doubt.
You can memorize every SMC concept, you can identify every liquidity sweep, you can perfectly map structure, and your trades will still fail. Losses are mathematical certainty in this business. Even the best institutional models only win maybe 60% of the time. The defining difference is how you handle the psychological fallout of the 40% that fail.
Let's focus deeply on the roots of frustration, because every trader listening to this knows the exact physical sensation. Your chest tightens, your face gets hot, the adrenaline spikes when that stop loss is triggered. Why does a losing trade hurt so much, and why does it instantly make us act so irrationally?
Frustration in trading stems from three primary psychological errors. The first is an intense attachment to the outcome. Beginners enter a trade expecting, demanding that it will be a winner. They mentally spend the profits before the trade closes.
I'm buying a new car with this trade.
Exactly. And when reality breaks that rigid expectation, it creates a massive cognitive dissonance, resulting in immediate emotional pain.
The second error.
Over-identification with failure.
This is
Devastating. A beginner takes a stop loss and their internal monologue says, "I am a failure, I am stupid, I am bad at this." They attach their personal self-worth to the red numbers flashing on the screen.
That is so toxic. How does a professional view it?
A professional takes a stop loss and their internal monologue says, "My hypothesis was incorrect based on current market data," or "I simply fell into the 40% probability bucket." The loss is external. It is an event that happened, not a reflection of their identity.
And the third error is unrealistic expectations regarding market behavior. expecting the market to move instantly in your direction perfectly smoothly without any drawdown or volatility.
Right. When you expect a frictionless ride, the normal chaotic turbulence of the order book causes panic.
We have to actively, consciously reframe how we view losses. A loss is not a punishment from the universe. It is not a personal attack by the market makers. A loss is data, pure objective feedback.
You have to view it as tuition paid to the market. You paid a small, predefined fee to learn exactly what doesn't work in this specific current market condition.
But reframing is hard when the physiological response is just pure anger. And that anger leads to the most destructive behavior in the entire industry, revenge trading.
Revenge trading is the desperate, impulsive urge to immediately enter a new position, often with doubled leverage, simply to win back the money you just lost. It is a complete abandonment of logic, structure, and patience.
It's just gambling at that point.
It is pure, unadulterated emotion driving the mouse. It is how accounts are blown in an afternoon.
So how do we intercept that feeling? How do we physically stop ourselves before we click buy again in a state of rage?
You must implement a mechanical circuit breaker. When you feel that heat rising, you must physically stand up and step away from the screen. But more effectively, you have to channel that raw, destructive emotional energy into a structured, analytical process. You must objectify the pain.
Our sources provide a highly effective, concrete exercise for this. Keeping a structured trading journal designed for exactly this moment, it forces the prefrontal cortex, the rational brain, to take back control from the amygdala, the emotional brain. Walk us through this exercise.
The rule is simple. The moment a trade closes in a loss, before you are allowed to look at another chart, before you touch your mouse, you must open your journal and answer 3 specific questions. Question 1, what happened?
Just facts.
Purely factual. You write down what was the setup, where was the structural level, where was my entry, where was my stop. You become a reporter documenting an accident scene.
Question 2.
Question 2, what did I feel? This requires brutal honesty. You write down, did I feel FOMO? Did I enter too early because I was impatient? Was I angry about a previous loss? By naming the emotion and putting it on paper, you strip it of its hidden power over your nervous system. You acknowledge it, which allows you to release it.
And the final question.
Question 3, what can I learn? This transforms the loss from a failure into a tangible asset. Did you ignore a higher time frame trend? Did you enter before the 15-minute candle closed? Did you place your stop loss inside the liquidity pool instead of below it?
Finding the lesson.
Exactly. You extract the specific mechanical lesson and you build a rule to apply it to the next iteration of your process. You transform mistakes into data.
I love this because it reminds me of a boxer in a sparring session. If a professional boxer drops their left hand and gets punched squarely in the jaw, they don't sit down on the mat and cry about being a failure at life. They don't scream at the glove that hit them.
No, they don't.
That punch to the face is immediate, highly objective feedback that their guard was too low. The punch isn't a failure, it is data. You don't get angry at the feedback, you fix your guard. Taking a stop loss on a fake out in gold is just a punch in sparring. Don't get mad at the market, fix your guard.
That is the exact mindset shift required to survive and eventually thrive in this environment.
Let's summarize the incredible journey we've taken today. We started by looking at a beginner staring at a screen full of confusing shapes, feeling the anxiety of not knowing what they meant. We broke down the true anatomy of the candle, revealing it not as a color, but as a historical record of displacement, imbalance, and a battle for liquidity.
We learned to read price sequentially, looking for the coiling tension of compression and the violent release of expansion.
We completely contextualized candlestick patterns. We stripped away the magic and revealed them as the footprints of human emotion and institutional intent. We mapped those footprints onto market structure, learning to identify genuine breaks of structure from the manipulative fake-outs designed to trap retail traders.
We exposed the ultimate trap, the liquidity sweep. We learned how smart money algorithms intentionally engineer fake breakouts to trigger massive pools of stop losses, using retail panic to fuel their own massive positions.
And we outlined a disciplined, rigid entry process to ensure we wait for structural confirmation and pullbacks rather than emotionally reacting to the initial spike.
And finally, we addressed the psychological battlefield. We learned how to detach our identity from the outcome, how to view losses as valuable market data, and how to use structured journaling to short-circuit the destructive cycle of revenge trading.
If you've been following along, you have moved from a state of confusion to a profound awareness of market mechanics. You've realized that the market isn't random, and it isn't out to get you personally. You now have clarity on how institutions actually operate the order book, and with that mechanical clarity comes true, objective confidence.
But before we conclude this deep dive, I want to leave you with a final, slightly provocative concept to ponder as you open your charts tomorrow.
Lay it on them.
Think about your entire trading history up to this point. Think about all those frustrating losses where the market stopped you out and immediately went in your predicted direction. What if those losses weren't because you were inherently bad at trading? What if, in fact, you were perfectly, flawlessly executing a strategy that was specifically designed by institutional algorithms to trap you? You weren't failing, you were playing your designated role as liquidity exactly as they needed you to.
That is a staggering thought to process. You weren't failing, you were just on the wrong side of the design. But now that you can see the matrix, now that you understand the mechanics of the sweep and the trap, how will your next trade be different? Now that you know what that jagged, volatile, terrifying chart on gold is actually showing you, you no longer have to be the bait. You can finally step back, watch the battle for liquidity unfold, and trade alongside the victors.